Tuesday, May 26, 2020, Maneco 64, home of alternative economics and contrarian views. Today I want to talk about how the economic picture, especially for the United States, for the UK, and Western Europe in general, is looking bleaker than most people expect. I also want to look at an article on Zero Hedge about JP Morgan and its views on gold. We're also going to look at the Dow, compare it to 1929, what happened then and what is happening now. I did a video a couple of months ago when the market bottomed, comparing those two time periods, and this is just an update for it. Look at the gold-silver ratio, which is doing not well today, which is a good thing for precious metals, I would say, in general. So let's look at why I think the economic prospects for the major economies around the world are not looking great. The other thing I would say is that this is going to make things even worse because the major Western economies have thrown everything in terms of stimulus at the economies, trying to keep it from collapsing. And you have to say, of course, it's a self-inflicted collapse because the powers that be decided to basically shut down all the economies. So it's not surprising we're going to see this and these lockdowns and shutdowns, whatever you want to call them. Yes, they're being lifted gradually, but I think it's done a lot of psychological damage to the general public. Of course, I'm not going to go into the debate about the whole thing. This is not the purpose of my video. It's more to look at the economy and what I think is going to happen. So I was reading the papers this weekend, and this one was from yesterday in the Telegraph. Of course, yesterday was a holiday here. It doesn't really matter, bank holiday, but it was anyway. In the business section, there was an interesting story here. It says, UK faces tsunami of job losses, warns Reed. So here's the story. I'll show it to you. There you go. So who's Reed? Well, let's go through the article and you find out who Reed is. For those of you who are not UK-based, maybe US-based, it says the UK is facing a tsunami of job losses. So that's not my term. This is not clickbait from me. This is from Reed. When the government's huge support for workers' wages is wound down, the boss of Britain's biggest recruiter has warned. So that's Reed. James Reed, chairman of online job site Reed, said he feared the labor market is heading towards a day of reckoning when the support ends. That's the furlough support. They've extended it, I think, till October, but at some point, the employers are going to have to carry a lot of that burden, and I think what they'll do, they'll just sack people or make them redundant. What's the point of keeping people employed if there's going to be no business for them to do? So it says, and I'm quoting Mr. Reed, the worry is what happens when furloughs wind up, he said. Is there a wave of redundancies coming? The danger is a tsunami of job losses, Mr. Reed added. Companies I talked to are a half or a quarter of the size they were when they furloughed people, or they are on the verge of going bankrupt. Economists fear a second wave of redundancies could sweep the UK as the furlough scheme is rolled back, threatening to derail the economy's recovery. Some 856,500 people made new benefit claims in April, 6 times higher than at any point in the financial crisis. While 8 million are furloughed, the jobs retention scheme could be propping up so-called zombie jobs that would not survive without the support The government pays 80% of furloughed workers' pay to prevent mass unemployment by the lockdown. These people, 8 million people who are furloughed at the moment, they're not counted as unemployed. So you can see how things could get a lot worse in terms of the statistics. The economy is unlikely to have staged a full recovery before the scheme is wound down, putting jobs at risk. Mr. Reid predicts unemployment will go up significantly and warned the jobless rate could top 15%. The number of jobs listed on Reid's site is down 57% year on year, a small improvement on a 68% fall at the low of the lockdown. So there you go. Things are not improving. Reid, I mean, they're the biggest online recruiter, job recruiter, or job search. So the guy knows what he's talking about. His clients are the companies that hire people. The other story that came out maybe about a week ago, but I didn't really see it, and I think it's quite significant. And we are in the period as well where I think we're going to start seeing in the States also a lot of people having trouble making their payments on finance, not just in individuals, but big businesses. We are entering pretty much, the third to fourth month after this lockdown. I think things are going to get harder. So this story here is from May 21st in the FT. Biggest U.S. shopping complex shows threats to mortgage-backed bonds. Vast Mall of America falls behind on payments that help underpin $500 billion bond market. I guess the Fed could buy these bonds, try to save it. But what's the point of saving a business that doesn't exist, right? That a business that goes under. So let's go through this story here quickly. The biggest shopping mall in America is delinquent on its $1.4 billion mortgage, in an ominous sign of how the pain in U.S. retail is infecting the $500 billion market for commercial mortgage-backed securities. The owner of Mall of America, a more than 2 million square foot complex in Bloomington, Minnesota, that boasts a Nickelodeon Universe indoor themes park and more than 500 stores, missed its mortgage payments in April and May. Documents prepared by Wells Fargo and reviewed by the FT showed the mall, which was valued at more than $2 billion in 2014, closed its doors in response to the virus in March, and its management has notified Wells Fargo, the servicer overseeing the mortgage, of the hardship brought by the pandemic. It is unclear whether the owner is seeking forbearance on the loan. The troubles facing the Mall of America, which is planning to reopen in June, are shared by other property owners grappling with lockdowns through the CMBS market, which slices loans into bonds with varying levels of risks, strains, filter through to the portfolio of pension funds, hedge funds, and other investors around the world. This is a little bit like the '08 crisis, where they sliced, the mortgage-backed securities. They made them look better. They haven't learned their lesson. So that's another disaster. I think they're in the wings. So I'll stop at that. And now we'll look at the markets. We'll look at the Dow compared to 1929 and what's going on. The stock market, ever since March 23rd, has been correcting higher. If you look back in the last 6 to 7 weeks, it actually hasn't really gone anywhere. If you look at the Dow over the weekend, though, and yesterday, which was a holiday in the States as well, the stock market has been goosed up, the futures. And we are at some important levels here. But as you see, I don't think this correction in the stock market has a lot longer to go. And why do I say that? Well, of course, Technical analysis, looking at cycles, is not always a perfect science, but I did this right after the stock market bottom in March. I think I did this towards the end of March, a few days after the stock market bottomed, and we saw a big rebound in the stock market. So here are the two charts comparing the Dow in 1929 and the Dow in 2020. So you can see here that we made a low on the 23rd of March at 18,213. The Dow made a low in November 1929 at 195 after touching an all-time high of 386 in September. The all-time high now was in February in the Dow at 29,568. And this is what I said in terms of the time that it took for the Dow to crash, the initial crash in 29 and the initial crash now in 2020. And I think this is part of a longer term crash. That's why I'm saying it's initial in 2020. So the Dow took 10 weeks from September all-time high of 386.10 in 1929 to November 1929 low of 195.30. Correction was 49.41%. And then the Dow rebounded just over 50% from the low in November to around 297 in mid-April 1930. So it took about 22 weeks for that correction to happen from the initial crash to the high in 1930. So this is nowadays. Dow took about 6 weeks to correct from all-time high of 29,568.87 on February 12th, 2020 to a low of 18,213.65, a correction of 38.4. So this is what I said at the time, a rebound from this low of around 50%, 50% retracement, that's what I meant, from the low to the all-time high would take the Dow to around 24,000. I said this move higher could last about 13 weeks, which corresponds to roughly 2/3 of the 22-week move in 29. Why 2/3? Well, because the initial crash happened in 6 weeks in 2020. In 29, the initial crash happened in 10 weeks, so 2/3. That's why I came to 2/3. So after a 13-week move higher to around 24,000, where could we expect the 2020 Dow to bottom, and also roughly when? In 1929, the initial drop was of 49.41%, and in 2020, it looks like it will be 38.4. See, at the time, we didn't know yet if we had bottomed back in March. And I think we can safely say that was the initial bottom now. Or 77% of the Dow 1929 drop. The 1929 crash from September to July of 1932 was 89.49%. So yeah, July 1932, that was the bottom from the whole collapse of the Dow in the early 30s. That was it. That was the bottom, 1932, July. So if we take 0.77 of 89.49, we get a correction of 69.53%. From the 2020 top, that would take the Dow to around 9,009. As I said there, from 1929, it took 35 months for the Dow to bottom in July 1932. So we think this time it could take 21 months, 2/3 of 35. So we could see the Dow bottoming towards the last quarter of 2021. So where are we now in terms of my analysis? Well, as you can see here, that March 23rd was the low. This is a weekly chart, it's different. And right now, this week, we're entering the 10th week. Yes, we have gone above the 50% here, but I can tell you that in terms of the market technicals, the region between 50 and 61.8 is usually a region where markets correct towards. And as you see today and yesterday, the Dow has been up quite a bit. So we are approaching the 25,000. Anything is possible, but I think the cycles are telling us that we've got another 3 weeks or so. So between mid-June and end of June, this is where I think we could see this correction starting to keel over. Is it going to be a big crash down to 9,000 right away? No, as I said, I think it could be more gradual towards the end of 2021, as I said in my analysis. So let's quickly look at where the markets are this morning. It's 9:09 a.m. London. I'm a little later than usual, but doesn't matter. So right now, the Dow futures 24,960, which is about 500 higher from the close on Friday. My system is telling me it's up 200, but it was up yesterday in the futures 300, so it's not counting that. So yeah, we're up about 500 points for some reason. I'm not sure why, but that's the way markets are. S&P as well is up considerably as well, but not as much as the Dow. We're at 3,012. What about the precious metals? Well, silver has done well today. It's up 26. Silver held well yesterday as well, while gold was completely trampled on. It was below 1730 all day. You could see there was manipulation, and I think there's manipulation today, but it's not gonna last. So right now, silver is at 1737. It's up 1.5%. Gold is at 1728. So actually down from Friday. We closed around 1733 on Friday. So that's a good sign for precious metals in general. We want to see silver outperform in the precious metals bull market. Yeah, the currencies are stronger versus the dollar this morning. That's normal as the Dow is being goosed up. The currency that is losing the most is the dollar. As I've said, all fiat currencies are sinking versus gold and silver, of course. So the oil price also is a little higher here this morning. It's up 50 cents at 34.38 WTI. The bond market has backed up. The yields are back up a little bit. We're at 70 basis points, still very low. So I think there's a big disconnect still between what's going on in the real world and what's going on in the stock market. But that's normal. Markets are irrational for a period of time. And I think the fundamentals will, how can I say, reimpose themselves. I think it was in April 1930, just before the Dow started going down again. That President Herbert Hoover, I think he made a comment, I paraphrase him. He said, well, it looks like the crash is over and business can go back to normal and we're going to see the economy go back to normal. And little did he know that from then on, the Dow would go down even more and be like almost 90% from its highs in September 1929. So before I finish, I spoke about a JP Morgan article about gold on Zero Hedge. So I'm not going to go through it too much because you should know already what gold is all about listening to my videos. I've been covering this since 2007. I had an article that I wrote for a blog that I used to keep for soundmoney.com. I don't have that blog anymore, but here's the article. It's on marketoracle.co.uk. I was saying 13 years ago that all fiat currencies were sinking versus real money. Well, JP Morgan's caught on to it 13 years later. It says JP Morgan, the surge in gold is a sign of eroding confidence in central bank generated money. So there you go. Even JP Morgan is catching up with Maneco 64. And they talk about how all the fiat currencies are dropping versus gold. and that's a sign that investors are losing confidence in central banking. Well, it's not even money, really. It's fiat currency or out of thin air credit. And they note, of course, that the dollar is the only currency right now that hasn't made an all-time low versus gold, and that it's only 9% away from that all-time high. So some of you might be thinking, well, you said gold would be at 2,000 by the beginning of June. Well, I still think we will. I know it doesn't look like it will get there the way gold is trading right now. But as per that technical analysis of the pennant, that's where it should go. Yes, it could take a little less time or a little more time. Yes, it could go to 1980 or 2100. But as I said, markets are not perfect. Would I be upset if gold doesn't get to 2000 by the beginning of June? Of course not, because that's not what gold is about, speculating on the price. Of course, some of you might want to trade it, but that's just my view. So I'm not telling you to go and buy gold because it's going to 2000. Because I've been telling people to accumulate gold on a dollar cost average basis. That means trying to get gold whenever you can, if you can get it on a monthly basis, just like you would put money away for savings every month. That's how you should look at gold and silver. So there you go. To summarize, the economies are not going to get better in the short term. I think they're going to be worse than most people expected. It's not going to be a pretty sight, unfortunately. And we're going to continue to see a lot of money printing or fiat currency printing by the central banks to support a lot of fiscal deficit spending. And that's just going to weigh even more on the economies, because where does government and central banks suck this power of spending, fiscal and monetary spending from? Well, they suck it from the private sector. So it doesn't make sense. It's the Keynesian fallacy. It's not going to work. So that's what we're in for, in my opinion, unfortunately. And that's why you need to protect yourself, of course. You should know by now, with precious metals. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.